Hello and welcome to BQ Prime. You're watching Talking Point, and my guest today is Gautam Duggad, Head of Research and Institutional Equities at Motilal Oswal. Gautam, thank you very much for joining us on BQ Prime. Uh, my first question to you is on the regional conflict which is coming up, which came up over the weekend, is the Israel-Gaza war. What could be the potential impact for Indian equities or in some of the Indian companies?
Good morning. Thanks for having me. See, this is a very evolving sort of a conflict. I think Israel-Palestinian crisis is not something which is new. In the past, also it has happened. Just the scale of conflict and the extent of damage is very different and disproportionate this time, and in a way, a bit unfortunate also for human lives. But as far as markets are concerned, Sajid, if you had seen the reaction of the markets this morning, global as well as Indian, and the way crude has behaved, because that is one thing which people always get most worried about, because supply chains come into picture, and there is always a sort of a panic reaction at the first instance. But we've seen that today, at least so far, the markets have been very mature and calibrated. And if you see even past conflicts, whether it is Russia, Ukraine, or the periodic North Korean related news flow which we keep getting once in a while, every once in a while, we've seen that typically this sort of things usually create a downward sort of a movement in the market for a few days. And then after a week or so, people move on to the next thing. And usually in the past, buying during such periods of downturns have helped. Now, obviously, every period has its own different context. So I don't want to second guess what can happen here. But I would imagine that in another 3-4 days, the market will start talking about earnings and other fundamental factors. So this can at max be a couple of days of a news cycle. Unfortunate as it is, but yeah, markets have handled it very well so far.
Do you think that unlike the Russia-Ukraine war, there could be an impact to the supply chain? Because that's much bigger worry, right? Because in the Russia-Ukraine, it was not a war, but the impact on the supply chain that led to a lot of issues. So do you see a similar impact coming in the future from this?
I would not imagine so, Sajid, because the commodities involved are very different. And this so far seems to be a very localized conflict, with most of the world opinion sided towards one side, right? In Russia, Ukraine, we have seen that the global opinion has been slightly more divided. While I'm not an expert on strategic affairs or defense matters, all I can say is it's too early to sort of pontificate on what exactly can happen to the supply chain. We will have to allow some time to elapse and see how things develop. This is still a just 48 hours old war. So let's see how things shape up and then accordingly form a view.
In this context, we've completed the second quarter. What's your take on the second quarter as earnings for Nifty or your portfolio companies?
So yeah, I mean, second quarter earnings preview we've just released, and we've done several changes in the model portfolio. We are expecting a very healthy quarter. First quarter, we had seen close to 30% earnings growth for Nifty and about 18% without OMC. We are seeing something similar this time around as well. 21% earnings growth for Nifty and 15% ex of OMC. For our broader coverage universe, we are penciling in a 40% earnings growth, largely because of a very sharp upswing in OMC's profits on a YOY basis. If you keep aside OMCs, then even for our coverage universe, we are talking about a 20% plus earnings growth. And this is a quarter where margin expansion will be very strong on a YOY basis across sectors. Auto, cement, consumer, metals, oil and gas. There's a few sectors where margin expansion will be very strong. We are expecting close to 250 to 300 bps of a margin expansion at operating level for different set of aggregates, depending on which one you look at. So while the top line growth is expected to be a bit tepid, given what is happening and given the fact that a lot of the inflation is in the base now, so we are talking about 6 to 7% top line growth. for both our coverage and about 8-9% for Nifty. But the EBITDA growth will be in the range of 17-18% and earnings growth in the range of 20 to 40%. That 40% spike is largely owing to OMCs in our coverage universe. Without the OMCs, for our coverage also, we are talking about 20 to 21% kind of an earnings growth. Sectors which are expected to lead are the same that we have seen for last 3 quarters, which is financials. Auto, once again, auto has had a very strong and a stellar run for the last 3 quarters in terms of earnings growth. We expect that to continue in this quarter as well. And then, oil and gas, as I mentioned, even X of OMCs we are talking about a 15% growth. Aside of that, tech is expected to be very muted, 6-7% earnings growth. Consumer about 14-15% earnings growth. And then we have sectors like cement, which are coming back after a very long time. The last time cement had shown an earnings growth was in September 21 quarter. After that, there has been an earnings decline for the next 7 consecutive quarters. And this quarter now we are expecting a very strong 70% growth on an extremely low base. So optically, it will look very strong. Because your EBITDA margins, EBITDA per ton, all of them are going to look pretty good. And sector which is not going to do well are some of the smaller sectors like specialty chemicals, where we are expecting about 20% earnings decline, and even sectors like retail, where also we are expecting a double-digit earnings decline because the demand has been very soft in the quarter that has gone by for segments like QSR, apparel, footwear. So net at an aggregate level, very strong growth led by domestic cyclicals, which is financials and auto.
Also, is it more going to be led more by volume or pricing as well?
So it's very difficult to categorize that pricing and volume equation at an aggregate level. You have to look at sector by sector. So for example, in auto, there is a contribution from both volume, pricing, operating leverage, as well as lower commodity cost. In consumer, it is largely led by lower commodity cost because the top line growth is just about 6%, which basically tells you that volume growth is extremely tepid and which is perfectly in line with what the managements have guided at the end of the first quarter FY24 earnings season and what we are gathering from the on-ground channel checks. In other sectors like cement, volume growth is pretty decent. I mentioned it for auto also. And then in some of the other sectors, volumes do not make much of a dent. Whether it is metals or oil and gas, there the underlying commodity price behavior plays a much stronger part.
So when you speak about oil and gas and this outlier which is coming in because that's bumping up the entire top line and the bottom line for the Nifty and your portfolio companies, have you factored in the fact that there hasn't been much change to the marketing margins and that could be muting the profitability point of view, not the EBITDA. At the EBITDA level they would be doing much better, but profitability level?
So as I mentioned, at the profit level itself, there is a spike which is coming in, but they've always been noisy on either side, whether on the downside or on the upside. Right now, it is contributing on the positive side. We've been used to seeing their negative contribution for a fairly long period of time. So generally, we sort of exclude them when we are performing any serious analysis on numbers and aggregates. So oil and gas earnings, specifically the 3 OMCs, they usually tend to sort of create a distortion in the aggregate numbers. So it's always advisable to look at the aggregate trends by removing OMC. As it is, there is just one OMC left in Nifty 50 index. So you just have to ignore that and look at the rest 49 companies when you're doing a YOY comparison to get a slightly more substantive insights. As far as their own stock performance is concerned, I think it's dictated by things which are outside the realm of fundamentals, which is what is happening globally to crude, how the government is reacting, how the politics is shaping up, do they have the pricing freedom, and things like that. So earnings necessarily do not make much of an impact on their performance, on their stock performance on either side.
Mm-hmm. In the technology space, Gautam, TCS is coming out with its earnings. There's a buyback also on the agenda today, the 5th one. Will that be enough to support the stock in the short term, given the fact the kind of macroeconomic headwinds and the muted earnings growth that you are projecting?
So, Sanjit, IT is going through a bit of a rough patch because of what is happening globally to the growth narrative and also to the interest rate movements that have happened, plus the commentary, which sort of signifies that we have not seen the last of the rate hike. And therefore, the concerns from a global growth point of view should continue to remain there. That being said, IT sector right now, very counterintuitive. If you look at the large cap IT stocks, they're almost at their 52-week highs, which sort of belies the underlying very weak growth narrative which is coming in. Part of the reason is because of the point from where we are looking at it. Because if you look at it from an October 21 perspective, most of these stocks are still down 20-30% from their respective 2-year highs, while the market is at a new high. Right. As far as TCS is concerned, we are used to seeing their buybacks and very healthy free cash flow returns that they provide. So this will be, I think, the 5th buyback. The last 3 buybacks put together, 18, 16, and 16,000 crores, they've returned 50,000 crore back to the shareholders. So one needs to see the details of the price, the quantum, and the method in which they will be doing it. But this is par for the course as far as the large cap IT companies are concerned, because they've established this practice now to return 80-90% of their free cash flows in the form of a dividend or a buyback. As far as the fundamentals are concerned, I think we might be in for a couple of more quarters of near-term pain as far as the sequential constant currency revenue growth is concerned, because the global macros are still not very looking rosy, and which is what we have seen commentary from Accenture also and numbers, I think, a couple of days back. So one needs to watch out for some of these things to clear. At the margin, however, the valuations are relatively more favorable for IT than what they've been for a large part of 2021. We are expecting a very muted quarter across the board for IT sector, just about 6-7% earnings growth YOY, and even dollar terms sequential constant currency revenue growth in a very flattish zone of 1 percentage point plus minus 50 basis point.
Mm-hmm. Another key sector which has been performing well is the banks and financial segment. Do you expect the NIMS growth to continue there and the top line for some of the banks, or there are some pockets where there could be some slowdown?
So we are expecting a moderation in the NIM net interest margins already. We had seen that in 1Q FY24, and that trend will continue in this quarter as well. And of course, for the next half as well. So insofar as earnings growth for the banks is concerned, we are clearly seeing a distinct moderation now, which we had highlighted when we released our first quarter's preview as well 3 months back. So we are talking about a growth which is moderating from 30% to 25% this quarter, and maybe about 17-18% in third quarter, and close to 10-12% in the fourth quarter for private banks, and somewhat similar number for PSU banks. So on an aggregate for the full year, the growth will still look pretty solid at about 20%, but it's a very non-linear growth in terms of quarterly distribution, because every quarter is slightly more moderate than the previous quarter. So let's see what the commentary is, because the credit growth is running quite fine at 14-15%. Maybe you're in for 1-2 quarters more of a NIM, which is now settling into a slightly more sustainable zone compared to what we had seen in 4Q FY23, where NIMs had spiked up to a very sharp, very sharp levels, which obviously was not sustainable. So nothing unusual happening there. It's just that the growth will look slightly moderate every subsequent quarter. But on the flip side, the valuations are extremely reasonable for banks, both private as well as PSU, more so for PSU, of course, and which is where we have a single largest overweight in our model portfolio with about 7% allocation to PSU banks. And we hold SBI and BOB in our model portfolio.
Mm-hmm. two sectors which I need your views on is the consumer sector, because the demand has been muted there. There was some expectation that after the monsoons, the rural demand may pick up, but monsoons have been pretty much at par. Do you see the revival of demand coming in from rural and semi-urban, and that helping both consumer and retail segment?
So, Sanjeev, my view is slightly, I'll break it into two different parts. When you say consumer, let's say consumer staples is one segment and consumer discretionary is another segment. As far as staples is concerned, I think the demand will take a couple of more quarters to revive, because the rural has been lackluster for some period of time now. And while the monsoon has revived in September, the August has been very bad, and that will impact sowing, or yields in some specific cases. Plus, as always, the monsoon has been very uneven in terms of spatial distribution. That said, second, the inflation has been also impacting the consumer demand on the ground, which is what most of the consumer companies pointed to during the 1Q FY24 earnings calls, and also at our annual global investor conference, which we did in the last week of August. So as far as staples is concerned, I think it will take a couple of quarters for volumes to revive. And at the margin, companies are not very confident of taking disproportionate price hikes. In fact, the competition from the smaller and unorganized guys in most of the consumer categories has picked up, which is what was alluded to by Hindustan Lever and Britannia and some other consumer companies also 3 months back. So they will be very reluctant to take any meaningful price hikes in an environment where demand is already constrained. So net-net, it will mean that top-line growth will look very, very sedate. And whatever earnings growth that has to come will have to come from margin management rather than led by demand. Whereas discretionary is concerned, we are seeing a very different trend emerging out there. You saw the press release of Titan on Friday. They're talking about a 20% top-line growth on a very high base. So clearly, discretionary is very different from staples as far as demand patterns are concerned. And within discretionary, also different segments have very different trajectories. So hotels is doing very well, jewelry is doing well, aviation is doing well, but at the same time, QSR, footwear, apparel are not showing that strong demand sort of patterns. So one has to be very, very choosy within the sectors and also within the categories that you choose in a sector. So as far as we are concerned, we are significantly overweight on consumption, and we have only one consumer staple stock in our model portfolio, which is ITC. We hold around 7 to 8 consumer discretionary stock, and our single largest section still continues for Titan for last many years and even now. Other than Titan, we hold Indian Hotels, Metro, Zomato, Lemon Tree, DMart, and Kajaria in our model portfolio.
Gautam, it was a pleasure talking to you today to get an understanding on the earnings season that's just going to start today for TCS earnings. Thank you very much for joining us on BQ Prime.